So welcome to our session on the voluntary carbon markets. I'm Joe Aldy. I'm a faculty member of the Harvard Kennedy School. It's my pleasure to host this session. I think what we hope to do over the course of the next hour is to explore both the opportunities and the challenges that comes to the voluntary carbon market. How do we think about the opportunities perhaps for mobilizing more finance in decarbonization? What may be some of the challenges of ensuring the environmental integrity of the actions that underlie offset credits that get transacted in the voluntary carbon market? Think a little bit about the institutional design, how it may interact with public policy. And I think the bottom line, one that we've talked a lot about today over the course of this conference, what role can the voluntary carbon market play in accelerating the reduction of greenhouse gas emissions here in the United States and around the world? So to address these questions, I'm thrilled to be joined by four leaders in the business, the policy, and the scholarship of voluntary carbon markets. We have with us today Nat Keohane, who is the president of the Center for Climate and Energy Solutions, also known as C2ES, a widely respected nonpartisan nonprofit organization that works with policymakers and leading businesses to accelerate the transition to a thriving, just, and resilient net zero emissions economy. I did not write that sentence. But I read it well. That's what's important. Donna Lee.
You're good even without punctuation.
Donna Lee, who is the co-founder of Calyx Global, a carbon credit rating agency. She's worked on climate change for more than 2 decades. Prior to Calyx, she was a U.S. climate negotiator, an advisor to a number of governments and companies on climate finance. What I know about REDD+ and related issues is because of Donna Lee when we worked together in the U.S. government. David Victor is a professor of innovation and public policy at UC San Diego, where he is a part of the School of Global Policy and Strategy and the Scripps Institution of Oceanography. He's also a graduate of the Harvard class of 1987, a class that includes many people now active on the climate challenge. So there's at least 2 of the class of 87. There's 3. Fantastic. And Carolyn Weinberg, who is an executive fellow at the Harvard Business School. Until recently, Carolyn served as Chief Product Innovation Officer at BlackRock, where she drove the product innovation, development, and commercialization of products globally for the world's largest asset manager, including in transition finance, digital assets, and fixed income ETFs. So I'm going to pepper them with some questions. They're going to give us some really wise answers, unless I ask some uncomfortable questions, and then they'll dodge them. Then we'll open it up for questions from the audience. But first, Nat, I want to go to you. Okay, so let's just sort of set the scene for us, help us understand when we talk about the voluntary carbon market, what do we have in mind, and how big is this market, and what is its potential, both when we think about it from a financing perspective, an environmental perspective, and a technology perspective.
Great. Well, thanks, Joe, and thanks a lot to the Slot Institute and Harvard for hosting this, and thanks Aldy for coming. I'm really pleased to be on the panel with really terrific co-panelists, Joe. So to set the stage a little bit, the voluntary carbon market is it's essentially the marketplace in which private entities, mostly companies, can go and buy credits that represent, ideally, real verified emissions reductions from a range of projects. This might be a carbon dioxide removal project that takes emissions out of the air and stores it underground, or it might be a project that replaces dirty cook stoves with clean cook stoves, and so it reduces emissions while providing benefits. It might be, Joe said, REDD, which stands for reducing emissions through tropical deforestation and degradation. So it might be a project to protect forests. There are other kinds as well. These happen all around the world, and there are methodologies and approaches that are designed to measure, we'll talk about this, designed to measure the emissions reductions and estimate the emissions reductions that come from those activities. So the voluntary carbon market is a place where companies can go and buy credits, ideally representing these emissions reductions. And why would they do that? Well, they might do that because they have a corporate climate commitment that says they're going to reduce emissions or they're going to contribute toward net zero. They might do it often on top of that, on top of steps they take internally to reduce their own emissions. Maybe they do this because their consumers are asking for it or their investors are asking for it, often because of their employees. We can talk about that too. The voluntary carbon market is distinct from a regulated carbon market. So there are places, including Massachusetts and about a dozen other northeastern states, California, the European Union, other countries around the world that have a regulated carbon market, often known as a cap and trade program. That's a regulatory approach that's enforced by government and the state. So we're not talking about that. We're talking about the voluntary approach. There are some of these methodologies, you can actually use those credits. You might be able to use those credits in some of those regulated markets or the voluntary market, so there's some overlap. But when we talk about the voluntary market, we really mean the things that firms are doing voluntarily. Finally, in terms of size, to give you a sense, so the voluntary carbon market, now Donna will probably have a better latest number than I do, but a couple of years ago, 2021, it reached a total market volume of $2 billion in 2021, and that was about 500 million tons or credits of emission reduction. So you can do the math. That's a pretty low price for those emission reductions. If we think all those emission reductions are real, then that's a nice sizable chunk. But $2 billion is still just a drop in the bucket. When we think about the kind of finance we need to mobilize to address the climate crisis, it's in the trillions. So we're just a few orders of magnitude off. There's also questions, as we'll talk about the integrity and the quality. Just for comparison, the European emissions trading system, which is the largest compliance market in the world, had a market value of $800 billion. So also very different. However, and this is the final point, there is a real potential here. So there was an effort done, an exercise done a few years ago by something called the Task Force for Scaling the Voluntary Carbon Market. You have to get used to lots of hard to follow acronyms here, TSVCM. By McKinsey and others, they estimated, depending on kind of the assumptions you make, that the market could grow to be $10 billion, $20 billion, even $50 billion a year, depending on the assumptions you make. And so that would be real money. It wouldn't be the trillions we need, but it would be an important contribution toward it. But that'll only happen if, I think, we get the integrity right. And so that's, I think, something we'll talk about today.
Great. So Donna, let me turn to you. You've worked in the international climate negotiations, going all the way back to the 1992 Earth Summit in Rio de Janeiro, where we first crafted the UN Framework Convention on Climate Change. There have been discussions about the use of offsetting projects in international climate policy. We've seen offsets used for compliance purposes in domestic cap and trade programs. CDM credits could have been used in the EU ETS through 2012 and a little bit after that. We have in California this. The voluntary carbon market is different. What do you see as the role of the carbon market and the key role of the buyers in driving this market?
Yeah, thanks, Joe. Thanks so much for inviting me to this session on the voluntary carbon market. I live and breathe it these days, working with Calyx Global. So I think, first of all, it's really useful for us to put the VCM in the context of all the things that we need to do in order to tackle climate change. I still believe that policy, and you and I remember during the Obama administration, trying to get a comprehensive climate policy, putting a price on carbon, that still is the fast and best means to tackle climate change. The voluntary carbon market is something that happens sort of, I don't want to say it's second best, but it's something that we do in addition to that. And what I would really like to see is this comprehensive price on carbon. That really is the golden egg, I guess. But in terms of thinking about the VCM, in terms of sort of comparing compliance versus voluntary market, because I think it's important to really make this distinction, and that you started to do this, which is great. Because a compliance market is policy, and policy, you can integrate lots of different interests into policy. So in a cap and trade market, you have companies in California, if they're over 25,000 tons, they have a cap, and there is a regulated authority, a body, a government, elected officials that has this accountability that's creating that market. So you have companies that are capped or under a regulatory system, and then in the case of California, like the Air Resources Board or some regulatory authority says, and then you can buy these offsets. And when they craft that, they can integrate all kinds of different things. So you look at Colombia and the carbon tax. They wanted to use the carbon tax to also drive finance to indigenous lands. Or you think about the IRA, right? One of the things in the IRA, which is the climate change bill by a politically palatable name, caps oil wells, but they don't cap the most methane emitting oil wells. It's the one nearest to communities, right? So in climate policy, you can integrate all these different considerations. The voluntary market isn't like that. There's no authority. By definition, it's an unregulated market. And for that reason, it lives and dies by confidence. And how do you build this confidence? And the fact is, the demand is coming right now, today, from companies that want to claim carbon neutrality, net zero. They might want to sell a carbon neutral product. And so for that reason, on the other side, the supply side, you really need to have credits that are what they claim. And that's really important. And I think that's a distinction between the voluntary and the compliance markets. Interestingly, Nat, you mentioned the TSVCM, the Task Force for Scaling Voluntary Markets. That changed its name to the Integrity Council for the Voluntary Carbon Markets. And I think
Didn't quite change his name, but we're gonna.
it morphed into the ICBCM. And I think it's because they had this original idea that we just want to create a market, standardize contracts, create liquidity, and scale. But I think they realized very quickly that you cannot scale without this integrity. And I think that integrity is absolutely important when we're talking about voluntary carbon markets.
Great, thanks, Donna. David, let me go to you. When I decide, let's suppose I've not actually ever done this. Suppose I bought some oil. I'm going to get 1,000 barrels, West Texas Intermediate. It's going to be delivered on a certain date to Cushing, Oklahoma. I know when that actually happens. I can enter into a transaction with a counterparty, and then I actually know when I've got 1,000 barrels, who knows what I'm going to do with it. I'm a professor. But I've got 1,000 barrels now in Oklahoma.
You imagine the solution.
Yes, as we're taught to do.
Yes.
So the challenge, though, when we think about offsets, we're often thinking about how we're reducing emissions from what they would have been otherwise. We don't actually observe or measure in a way like we often do when we think about, say, transactions in physical commodities. And that's one of the reasons why there have been these concerns about low integrity credits. Credits for activities that would have happened otherwise, credits for activities that may store carbon only for a temporary period of time in biomass and not for a permanent basis. So how do we think about how serious this problem is, and how should we go about trying to address what appears to be this sort of significant overhang of low quality credits in the voluntary market?
Yeah, so I think it's an important question because this is a fiat currency. So it's only as good as people's confidence in the rules, the integrity of the rules underlying it. And full disclosure, I've done a lot in this area, and almost all of it has been critical. And it's not that I don't understand the theory behind this, and it's true, you cannot do serious climate policy without some kind of price on emission. Without the price on emission, everything else is harder. It's harder to figure out where to allocate resources. And so, in a world that doesn't have a universal global carbon tax, it's called the imaginary world, that has that universal global carbon tax, the voluntary markets are a second best, but they might be a second best that works, and in particular for firms and governments that are highly motivated. So I get the logic behind it. Then historically, the real world has gone through many experiences like this. We went through the CDM, which was compliance, but had some voluntary aspects to it because of the nature of the way international commitments are set. A lot of quality problems with that. We had this huge wave of many forestry projects that were basically garbage projects with low prices because low quality. So since the markets are working, and so the real world has delivered a lot of low quality, and now we're starting to see it turn around. And I think that's actually very encouraging. So I just want to say just a couple things about this. First, what do you do about the overhang of quality? I think there are two overhangs that are a problem. One is the actual physical tons that are out there that are kind of garbage tons, that are kind of zombies. Right. If we get the incentives right, those will get priced to zero, and they will, disappear on their own, especially in a world that does what Nat is talking about, where we get the rules right and the market scale, because then they're going to be a tiny volume, a few 100 million tons max of a big market that's getting bigger, and so that it'll get lost in the rounding error. Although there is an overhang, a lot of companies want to go buy these things, and they don't know why should I spend $20 a ton for credit when I can get one for $2? Why not buy the $2 a ton, except that it's garbage, that's why you don't buy the $2 a ton. So there's the overhang of the physical tons. I think the much more important overhang right now is the confidence overhang. That experience of garbage in the market makes people wary, and that's really important for the voluntary market, because who's buying the voluntary credits? It's a lot of firms that are motivated to go do the right thing, as it were, and they're now leading the charge. Not everyone, but they're leading the charge for higher quality. I want to close by just saying there's a tension as we start to get it right and we create the incentives for for high quality markets. So like HR 87 colleagues have started a company that's just done a big offsets deal, higher quality offsets along with biodiversity benefits in Panama, selling to Microsoft among others. And so you're starting to see these deals happen, and I think that's really very, very encouraging. But there's a tension, because on the one hand, the people who want to make this thing big, and the traders who want to trade this like pork bellies, kind of trading places moving to apply the carbon, they all want common rules. But the reason we're getting higher quality right now, I think, is because we don't have common rules. And so I actually think the balkanization, although it freaks out the traders because they don't like something that has lots of different complicated rules, and so they want to see homogenization, we have to be cautious that we don't homogenize too quickly, because we'll homogenize the lowest quality.
Thank you, Dave. Carolyn, in your time at BlackRock, you did a lot of work developing new financial products. In a sense, a carbon credit is something, at least it didn't exist when I started working on climate change. That's because I'm old. But it's one of these things where we're seeing this kind of innovation in the financial space. We're seeing further innovation on different products, derivatives of carbon credits, insurance instruments for carbon credits, et cetera. So could you reflect some on your experience with new products to sort of talk about how you see where we are today with carbon markets and what you think the prospects are in the future for the carbon market?
Absolutely. So let me first start by talking about there's a massive trend of investors looking to invest in this transition to net zero. And what I mean by that is that individuals like ourselves may say, gosh, I have a brokerage account, I have a bunch of securities, I may have the S&P 500, I may have the ACWI, the world indices, but gosh, if it only could have like a lower carbon footprint from my investment perspective, that would be amazing. So you have this trend of investors like us, like wealth investors we call it, or individual. Then you have big institutions who say similarly, gosh, I would love to invest my public portfolio in lower carbon emitting areas or emissions. But how do you actually measure what that means? What is the carbon footprint of my investment portfolio, either public market, and then we can get more complex into private market. But there's this giant trend of investors, wealth or institutions saying, where am I at today? What am I doing today? How do I actually move this business forward? How do I move the market of investing in the transition? We talk about the trillions of dollars needed. We all are going to have to finance that in different ways. We all have our pieces of the way to do that. But we need to be able to measure where are we today and where are we going. So that's just a big trend from the investment perspective. The carbon markets themselves play a really interesting role in that for any one of us who wants to buy a portfolio of investments, we could actually also include a carbon offset in that portfolio as one mechanism. Instead of divesting from some area, one could actually say, I'm going to invest in addition. So as you think about the evolution of investment products, how does the measurement of carbon, the investment in potentially carbon markets, and how does the assessment of the whole portfolio over time and the transition of it until you're decarbonizing the portfolio, how does that evolve, if you will? So we talk about participants today are really companies. We talked about Microsoft, we mentioned, you said companies. Everyone's talking about companies buying. But actually, in order to have a functioning market, you need more than just one type of buyer base. And you can't just have a buyer, you need buyers and sellers. So how does that work with our traders? In fairness, the more diverse participants in a market, the more you actually can create a market. At the moment, today we don't have a market. What we have today is our series of projects and a series of data, if you will, that you can put into a portfolio, invest as a company, and retire. But we don't have a real functioning market from that perspective. So when I think about financial markets that I've built, or products that I've built, transparency, data, all of that, like what am I buying? What does it look like? Will it still be the same tomorrow as it was today from what I expect? All of that needs to actually exist. So I imagine a world where investors like ourselves, investors like big pension funds, investors like big endowments will be able to say, gosh, my portfolio of all that I've invested in today has the following carbon footprint. I expect it to look like this over time, and I may include either reduction credits or removal credits in that portfolio to achieve the goals I'm looking to achieve. That's where I see then a market developing, because you'll have buyers, sellers, you'll have data that is measured, transparent, and it doesn't have to be equal to each other from the perspective of lowest common denominator, but a standard by which people feel comfortable.
So we do see this kind of balkanization. In the last table I saw, there were like 10 different standards that you could register your project in if you were developing a new project. We have a number of ratings agencies that are emerging as well in this space. In a sense, we have the Integrity Council has their set of principles. We just heard from the White House and a number of agencies a couple weeks ago with their set of principles. So there's in a sense where there's this kind of evolution in, if you will, sort of the institutions that govern this market. So if we think that there's a potential here to sort of leverage market forces to ramp up financing and decarbonization, what do we think about the different roles of ratings, of liability, of factors that may influence prices, that gets us away from, I may buy the $2 garbage because it's cheaper than the $20 quality, and gets us actually moving towards quality projects where we have greater confidence about the environmental return. Go ahead, Matt.
Thanks. I wanted to dig in a little bit on that question, and Donna mentioned the Integrity Council for the voluntary carbon market, which we've been part of helping to create. So that might be a good entry, and then Donna can talk a lot more about the details of ratings and that sort of thing. So I'm an economist, and one thing I should say from the beginning as an economist is it's sort of funny because we're talking about a market that from a strict economics perspective shouldn't even exist, right? I mean, we're talking about a purely voluntary market that firms are willingly forking over money for public goods. So that's kind of interesting, and so we're talking about how do we turn that, like spin that into something real. But sticking within the economics frame, I think about this when we talk about quality, and I think David spoke to it really well. This is a classic lemons problem, right? So if you're not familiar with the lemons problem, think about a used car market. The lemon is a bad car, and in the absence of good information, I guess this was before the days of Carfax and whatever. Joe Stiglitz won a Nobel Prize on this. It was very hard for people who didn't sort of walk around with a mechanic all the time to tell the difference between a good car and a bad car, a lemon. And if you have a market in which you can't tell the difference between a good car and a bad car, or a good credit and a bad credit, the bad credits will chase out the good. Right? Because the average quality is lower than the good ones, and people aren't going to buy the good ones. Why buy a $20 credit when you buy a $2 credit? They seem the same. And that's the problem I think we've had in the voluntary carbon market. It's been very hard for most companies that are interested in this to tell the difference. Companies that companies have invested, I can speak more to this, but companies have invested huge amounts of money with teams of people doing due diligence in these projects. It's a very bespoke market. And there's two problems with that. One is, that's a huge amount of resources going. You don't have that in other commodity markets, right? People investigating every single project. It's very hard to do well. And it also means you're never going to scale, because you're never going to have just people who say, look, I want to buy carbon credits, tell me what's good. I'm exaggerating a little bit. There are lots of programs out there that have done really good work. But those programs, each of these programs all administer methodologies, and they verify the credits, and they have validation and so on. But those are uneven too. And so some of the methodologies are really good and some are not. Okay, so how do we solve that lemons problem? One way we're trying to do it is, this is the mention of the Integrity Council, set a global benchmark quality standard. Okay, it's like a good housekeeping seal of approval for carbon credits. And the idea is there's a set of core carbon principles that came out last year. It's very simple. It's not granular, it's not a rating, it's just yes or no. Yes, you meet the carbon crediting principles. No, you don't. And it's done at the level of these programs that administer the standards that administer these methodologies. So you can go onto the Integrity Council website. You can see what they do. You can see the assessment framework. They're following the assessment framework. We're starting to now come out, and this is going to be really interesting to see. Last week, was the first wave of methodologies that the Integrity Council said, okay, we approve these. These are eligible for a label, a core carbon principle label that will start showing up in the market. And it'll be very interesting, I think, to see whether that leads, what we hope it leads to, is a price premium for the high quality credits versus the low quality credits. Over time, the scale growing and the sort of good credits chasing out the bad. Maybe we can go back to the question about homogeneity. I think I probably differ David on that. But this is an example of where, this sort of self-regulatory approach. The Integrity Council is purely, it's a nonprofit, it's funded by philanthropy, it's not a regulatory agency, but we're trying to do it in a way that almost looks like a self-regulatory agency.
I would say, Donna, I want to go to you next, but I would say, I feel like it's quasi-regulatory. The entire process, you put out a proposal,
So it
you took
helps,
public
yeah.
comment, you had some virtual town halls.
So the chair, and that's very deliberate, the chair is, for two reasons. One is the chair is Annette Nasser, who is a former SEC commissioner. So when she came in, she said, all right, we're going to do this in a really clear way. The other is, Donna said something really important, which I totally agree with, which is, and David said as well, where this is second best. I don't even know if it's second best. It's well down the list of best. First best would be, not necessarily the imaginary world. First best would be great if we had the imaginary world, but just having more policies out there and more carbon prices out there would be great. And so part of the reason we're being so transparent about that is in the hopes that maybe at some point we could say, hey, we've done all this work. Here's all the record of the public comments and all these things. And maybe that's the basis for governments to build on.
Yeah, there's like so much to respond to. I feel like there's a whole buffet out there. Carolyn, something that you said that really resonated with me is that, we're in a really immature market right now, and the one that you've operated in had a lot of maturity. We just don't have that kind of diverse participation that a mature market would have. And so some of these new products that you mentioned, I think are important to mature the market, and the ICBCM is definitely one of them. The reason why we started Calyx Global was because what we saw in the VCM, so the VCM is this really odd assortment of actors, right? They're all come together voluntarily because there's no regulation again. So in this ecosystem, what we saw was that everyone was there to make the market, right? As of, let's say, 3 or 4 years ago. Everyone's business model who was within that ecosystem was tied to volume to make the market. And so what we needed in that space to try to elevate it, right, to try to help it optimize to the most mitigation possible was an entity like a ratings agency, and we really tried to make sure our mission is better carbon markets. We say for the planet and for people, we want to move the market into higher impact, and we really try to make sure our business model is disconnected from making the market, right? That our business model is aligned with the atmosphere. And I think the ICBCM is another entrant into this space that's very similar in that it's not trying to make the market per se. I think the difference I would say between the ICBCM and Calyx as a ratings agency is that we do believe in this, that the market is highly diversified, that it's not black and white. And in some ways, standard setting bodies, the ICBCM creates a bit of a black and white world. They set like a bar, a standard, everything above it is in, everything below it is not in some ways. And I think what we see in the market is really differentiated assets that are being created. So you can have an asset that has, the durability of 1,000 years because it's a CCS where you're stuffing it down into geological storage, right? That's very unlikely to be reversed. And then you have something that may be a protected area for a shorter period of time. You have some credits where you can measure things really well, and others where there's going to be a little bit more uncertainty. So I think there's a real differentiation, not on the carbon accounting side, but also on the other, what we call benefits beyond carbon. So a lot of these credits, these assets that are created, also provide wonderful contributions to sustainable development, to biodiversity, to human health. They create jobs and employment. So that also creates, again, we start seeing like these assets are really different. And so I guess that's why we believe as a ratings agency, we're looking at all these different qualities and trying to provide buyers with the information that we hope they can use to make those choices, decide how much risk they want to take, decide what type of co-benefits or extra benefits that they want to support. I think the ICBC, if I think of just like the bond market and ratings, in some ways I feel that ICBCM sort of sets that investment grade junk line, whereas we're creating this real differentiation from top to bottom.
Yes, I think really quick, I think they're very complementary. Like I think you can think about the ICBCM, it's like yes or no. and it's a pretty crude by the widespread measure. And then if you really want the detail, you go to Canada.
I'm going to go to David, and then I want to go to you, Carol.
Sometimes all these systems are hard to follow as Game of Thrones. A lot of different schemes going on. And I think that's the nature of the market. It's grappling with the quality problem, and it's good right now, up to a point. All these ratings efforts, standards, we should make sure that if we're going to set market-wide standards, that should be thought of and designed to be floors, not ceilings. Differentiation can be helpful to reveal information, and so on. It seems to me that this is a high transaction cost world, and so all else equal, this world will take off more rapidly with big projects than small projects. There's a lot of political pressure to try and reward small projects. We need to be cautious about that because if we really want the market to take off for quality, I'm very concerned the systems are not designed for enough assessment. At least I will say the last few rounds have not been designed for enough assessment. They were opaque. Chuck Sable and I have this book out on how society solves problems when there's a strong motivation to solve a problem that nobody knows what to do. And the answer is you run lots of experiments and you build institutions that can very quickly learn what's working, what's not working. So I hope this kind of alphabet soup of institutions will include some folks who are really actively trying to figure out what's worked, what hasn't worked, red team these activities, and so on. Just two last comments on this. One is, I'm a huge fan of buyer liability and insurance. I understand why for a long time folks have resisted that because they want the market to have low transaction costs and lots of liquidity. You need to create an incentive to price delivery risk and an incentive to create a secondary market called insurance that can offset those delivery risks so that you can create this kind of dynamic that is a race to the top in pricing things correctly. And I just want to close by saying, one thing I think we have to recognize is that the firms that have the highest brand risk and are buying now a lot of these credits, they are scared, I don't know what the technical term is, but they're scared in a big way, it's a family program, about the quality problem. And so when they're going out to the market, Donna mentioned this just in passing, but I think it's a really important point. When they're going out to the market, they're looking at projects that aren't just carbon, but they're generating other things that people care about. Biodiversity, I was in a redwood forest yesterday that's monetizing credits. Half the monetization value is ecosystem services, not carbon. It's in a compliance market, but the logic is the same. And so I hope that we make sure that our monitoring and verification systems have a door open to all these other services that people are now increasingly seeking from these projects because they're so gun shy given the previous experience.
So, Carolyn, if we're going to be able to scale up finance here, you talked earlier about the need for data and transparency. We've already heard of a couple of examples here. And David, in a sense, was talking about we had this kind of experimentation. At some point, we should learn and then decide and perhaps converge on what is a high quality standard. When you think about this, is this enough for you to say, I think you could, if you did all this, yes, you could scale? Or do we need more to build the institution of this market?
So first is we've been here before with other markets. So for those so most of my career was in derivatives markets, particularly fixed income. For those of you who know about the swap market, IBM and World Bank did the first cross-currency swap. One wanted one currency, one wanted the other, and they're like, oh, let's come together. That then developed this massive swap market. When I first started working in the swap market, we would have two sides. We'd staple them together and bring them to the risk team. This does not exist today. Obviously, there's trillions of dollars cleared. The world works really well. Everyone's like, oh, I want this, I want that. So we've been there before. Companies wanting to do some things, getting together, and it evolves. Now, there's a lot of bumps that happen in the swap market. I think all of us remember Procter & Gamble, Orange County, Gibson Greetings, not great stories. They did derivatives, bankrupted the company, or some bad things happened. So I'm not suggesting that it was all smooth moving. At the same time, we learned a lot from watching markets grow. Markets evolve from these seeds to actually something real, to actually driving great risk management and investments. There are many other examples, but the swap market comes to mind as I hear all these these are seeds and small things. One of the most important developments, if we go back to the swap market, was actually FAS 133. How do you account for these things? What's the mark on these things? How does it work? And how do you evolve that? We're missing that here. So for me, one of the most important elements is actually how do you account for it? If you're a company, how do you actually account for this asset you have, this one carbon ton that's a removal or a reduction, what does it look like on your balance sheet? What have you done with it? And how does it actually flow through from that perspective? That's probably one of the most important next steps, to have an accounting standard that people recognize, that is consistent, and that actually could be almost like globally used. So that you actually have this global nature, because the market is global. You're investing in a project wherever it might be, but there needs to be the same standard for that same exact credit, or the identical credit traded elsewhere. So I think that all of these elements of quality are critical, rating agency critical, different standards actually is completely reasonable and fine. Like, there are many ratings agencies that will say, like, that bond's an A, that company's an A-rated credit, and someone may say it's actually A- or actually BBB+. Like, it doesn't, that's great. Moody's, S&P, Fitch, there's room for others. Like, Bull came out with one. Like, great. That's okay, as long as people understand what they're reading and what they're doing. At the same time, accounting, I think, is sort of like above, at the same level, if not above that, from the perspective of actually developing standards and markets. Because people they can, as long as they can read it and like do the math, they'll do it. I think Nat walked through a bit of one of the biggest issues of scale is that actually all these companies like Microsoft, or even from BlackRock, and many of you all know, like, there are teams of people evaluating each of these projects. That is not sustainable. That does not actually scale. So the ability to have ratings, or to have to trust that someone else has done that work, is probably, that might be related to rating, but it's a bit about, like, how do you actually disclose the same amount of information to everyone, so that you can actually have a standard, which again goes a little bit back to accounting, because everyone, if you're listed on the New York Stock Exchange, everyone's going to read their financials the same exact way. So how do you actually read the financials of whatever this project is the exact same way? It's all like related to accounting, if you will, and then you can actually then do more work. So transparency, data, but accounting is in my mind a critical piece to scale anything.
So I think maybe it was Nat who noted that if you actually believe in the economics, this market shouldn't exist. So this market exists in part because we have these companies that set voluntary goals. They've said they're going to reduce their emissions. More and more of them say they're going to reduce their emissions to net zero levels by some point in the future. And so that has created demand where they realize some of my emissions are hard to reduce in the firm. And there's this opportunity to buy offset credits outside the firm to make progress on that goal. We've seen recently the Science Based Targets Initiative said originally, we don't want you till the very, very, very end to use any offsets. And now there's been some discussion about whether or not you should allow offsets for part of the value chain that's hard to decarbonize, and that created a bit of a kerfuffle within the organization. So how should we think about the buyers in this market? Should they have limits on how much they can buy? I mean, some of this conversation, we saw it in the principles that came out from the White House just a few weeks ago, but we've seen this in other places, the Oxford principles. It's kind of do as much as you can within the corporate footprint and the value chain, and then, as a last resort, buy these offsets. It actually reminds me a little bit of the old supplementarity debate in the Kyoto era of whether or not countries
really well.
whether countries could go out and buy emission allowances from others. So how should we think about the appropriate use of the offsets? How much is appropriate for a firm to use? And how do you actually operationalize, let's say, to echo a theme from this morning, hard to abate within a firm? David.
First, I don't think we should assume that the firm is the right unit of analysis for solving most of these problems. So the idea that every firm individually should be some city-state and go off and solve the climate problem on its own is nuts. And when you say it that way, nobody could possibly believe that, but that actually the way a lot of firms are talking about accountability, that even the industry, some industries will cease to exist or become much smaller. We just don't know what the boundaries are between different firms and industries. And that's one of the reasons I think that most of the SBTI stuff is a complete dead end. The idea that you could know from the beginning, sitting from the outside, what the right trajectory is and so on is just crazy. So I expect that most of that's going to collapse. And this discussion about what's the right role of offsets and so on is part of that. But let me come back to your question about should firms have a certain number, have a magic 8 ball in the CEO's office and turn over the number 6 or whatever. I think We don't know. But I think firms should explain. So why are firms doing this? A lot of the firms are they're worried about loss of license to operate, they're worried about future regulation, in some cases they're trying to do things and show how to do it because they're going to try and change the rules for the entire industry, like what America's doing in shipping. And all of that's good. So firms should say, here's our philosophy on the role of offsets and why. And here's what we're going to do internally and why. And here's how we're going to know whether it's working or not and why. And that last step is also really important because the others are a function of that. And we're about to see at some point, I think it'll take longer than it should, a lot of firms start blinking on their original net zero goals because they're not achievable. And you're going to have some firms that are going to blink, like just run and hide and hope nobody notices them. And then others will blink responsibly, if that's the right concept, that will say, we couldn't meet our goal, but here's why, here's what we're doing, here's what we think is more achievable, less achievable, and here are the kinds of things we're going to do along the way, and here's what the right role for offsets is in that. Like that's an honest dialogue where you focus less on the top level numbers, bottom level numbers, depending on which discipline you come from, and more on the meat.
Having like a credible, transparent process.
Yeah, here's how we know, because most of this is unknowable.
Yeah, if I can follow up, I really like, David, what you're suggesting, because at the end of the day, this voluntary action, it is about almost social license, right, to operate. And the reasons why companies, we work with a number of these companies, like Meta and Salesforce, and even a couple of universities, and I think a lot of it is around this social license, right, and wanting to be credible and to add to their brand in some ways by having really strong climate policy and following through. But there's no one number. We work with, we have seen companies blink. Sometimes it's because they're scared to be the next, front page of the Guardian for buying the wrong offset, or, they've had a tough year, right? You can't expect a thin margin or a company that's doing poorly and can't get that bottom line to be buying the $600, durable offset. It's just not possible. So I don't think there's a single number, but it's similar to what we always tell companies, or what I tell companies, is to be transparent, to tell your story in a way that is credible for you and your company. And if you are transparent and you tell that story and you talk about why is it that you did X, Y, and Z, I think that helps a lot. I do think it's important that companies first and foremost try to reduce their emissions. If they're not doing that, then it's not going to be a credible story. So there are some sort of basic rules, I think, to be credible. But after that, I think we have to allow some flexibilities for companies to act in ways that make sense for them.
Okay, just before you jump in, Nat, let me just I'm going to go to the audience, so be ready for your questions.
Yeah, so I guess I'll continue in on the economics vein. So, and I haven't thought about this before today, but I think we talked about the lens problem, which is an adverse selection problem in economics. On the demand side, on the buyer side, I think the concern is a moral hazard problem. And what I mean by that, so my friends in the environmental community to my left, and my folks at SBTI that Joe mentioned, their overriding concern is that if carbon credits are available, firms are going to go buy them instead of making changes they need to make internally. And I'm going to try to do my best to put envision how this argument can be made in the best way, because I basically agree completely with David that the firms, it's weird we're talking about the firm, but I think there's the traditional argument around carbon credits is, look, a ton is a ton, wherever it's emitted. All this is true, right? So this is absolutely science-based, what I'm about to say. A ton is a ton. All that matters is the accumulation of greenhouse gas in the atmosphere, so we should cut as many tons as fast as we can, as cheaply as we can. That's what a market does. Why are we getting in the way? If firms want to buy 100 tons rather than 10 tons, that's great. And if they want to do that instead of doing something internally, why not? It's all that matters is the tons. That's very true, and it's missing something. So there's another side to this, which is, the other argument is, okay, but if we are going to get to net zero, which is a necessary condition for stabilizing the climate, we're going to need to transform our business models. We're going to need to transform industry sectors and how businesses do things. And the only way to do that is to start making investments in changes in those operations. You can't outsource that. So if you want to figure out how to go to low carbon, I know Amelia had to step out, but if you're thinking about, Andrew Forrest and Fortescue, and you're trying to figure out how to get to low carbon industry, you can't do that by planting trees somewhere, or even by high quality CDR, carbon dioxide. And so that's the tension. How do we give firms a tool to do this in a high integrity way without sort of giving them a free pass, as it were, and not having progress on that internal transformation? I agree with both Donna and David that there's no one single number. I'm intrigued by David's suggestion, but I think ultimately, for better or for worse, I think the NGO community, the nonprofit community is going to want it. Like, it's a social license that partly gets created by social actors. So I just want to point out there's another effort here. It's a different arrangement of the letters I, C, V, and M. So VCMI, different organization entirely, but a sister organization to the Integrity Council, is the Voluntary I told you there are going to be a lot of acronyms. It's the Voluntary Carbon Markets Integrity Initiative. And it's trying to get some sort of standards on the demand side. So it's just worth saying, one answer to Joe's question is, well, we should try to create consensus, just like we're trying to do on the supply side. What does a good credit look like? We should try to create consensus around what companies can do. And VCMI is coming up with, kind of like LEED. Everybody knows LEED for buildings. There's platinum, gold, and silver. And so VCMI is trying to come up with sort of platinum, gold, and silver ratings for companies. How many offsets can you use? I don't know if they'll succeed because it's hard to create that consensus, but it's another route.
So first is this license to operate. I would actually go one step beyond the concept that's like a social license to operate. I think that as we move forward, it is just a license to operate and it's a license to do business. For those who have responded to RFPs from clients, there's always a whole section on how is your business transitioning in this lower carbon world. What is your business model? How much investment? What's your capex? Whatever it might be, what are your commitments? And if you don't have any, you will not win the RFP. Full stop. So it's more than just a social license in my mind. It's actually there is a demand that is around this world, maybe less so in certain parts of the U.S., but for the most part, you go to Asia, you go to Europe, and there is every single RFP will have elements of sustainability and climate reduction and decarbonization. So if you're a company and you are trying to sell goods, and the only people who want to buy your goods are only going to buy it if you actually are transitioning and reimagining your business model to that point, well, gosh, you're going to do that. So even if you actually hated the concept of decarbonizing, and if you only were money making, you're going to do it because you have to do it because the people who want to buy your goods want you to do it. So I feel like that tide is moving fast, and it's in all elements. It's not like you go to the supermarket, you can buy a plastic cup, or you can buy a bamboo cup. People are buying more bamboo, and they don't they want to. There's a demand for that. There's become lots of things that are more eco-friendly that people buy. There's that is not because people don't want to buy it. People want to buy it, therefore people are making it. So for me, there's this whole just massive demand wave that's taking place. What happens is these companies who are reimagining their business models, well, they are actually going to finance the transition. As much as we could say these individual companies, they shouldn't, in reality they will and they are, because as they reimagine their business models, they're reimagining the supply chains. And they're saying, gosh, I really want green electricity to power all of my, whatever it is that are my factories or whatever it might be, because gosh, I want to tell my clients that I've done this in this way. So in that reimagining or rewiring of the business model, you have lots of offtakes that these companies are able to do. So whether or not you're a car manufacturer or whether or not you're a Walmart, right? You're going to want to start reimagining and rebuilding. Therefore, you're going to want to secure greener offtakes from whatever the companies are. Therefore, they themselves will be financing these new projects. So ultimately, as I see the world, there's a demand that is making companies evolve. Those companies need to evolve, and in that, what's happening is they will therefore finance to secure their ability to evolve these offtakes. And part of that will require some elements of carbon markets, because ultimately, I think this market should exist because it's really about allocation of resources around the world. Like, that is what markets do. Whether or not it's a commodity market, you supply and demand of that oil, who needs delivery of it at that point. Ultimately, who needs delivery of that carbon offset, assuming the accounting works and you can actually use it. Gosh, that's great. Like, if someone in one part of the world is able to generate something that someone can use in another part, it is a functioning, making sense global market. So I guess for me, I think one is about more demand, two is about actually offtakes and the role corporates have to play to de-risk some of these investments, as well as actually to reimagine the supply chains and the entire sort of business models. And lastly, again, a classic reallocation of resources using markets.
Great. Let me open it up to the audience for questions. Really?
I got called out.
You got called. I told you last night I'd call out.
I'd love to ask, I do have a question. I'd love to ask how you think about the evolution of market standards over time. And this is a question that I get a lot from buyers because many are making long-term purchases. And so it's really important that with ICVCM today we have a floor. If the floor were too high, it would clear the market and ultimately be unhelpful. If it were too low, it wouldn't engender trust. When people are thinking about making long-term purchases, they want to know how that floor is going to evolve. As some of you know, I spend a lot of my time on carbon removals. When we think about how the market evolves over time, when we get to net zero, almost by definition, there's no more reduction at net zero, there's no more avoidance, we're mainly just removing. And so that also when we think about how the market evolves over time, there's a subject about the types of credits in the market, not just the quality of credits in the market. So across your work and your areas of focus, how do you think about the time dimension as it affects the way that we should think about and plan our actions within voluntary carbon market engagement?
Yeah, it's such a great question because I think we're going to see evolution in this market, and it'd be tough to bet on an investment that only looks at today. I think your question is spot on in terms of thinking about how this is going to evolve. So actually tomorrow, Calyx Global is going to put out a state of the quality of the VCM report. And I think what you'll see, and we looked at time series data, is that we need to shift to higher quality. And I think the ICVCM is playing a big role in this. I think ratings agencies can play a role, but we're not there. And you're exactly right. So even the ICVCM is having to make some really tough decisions. And I think over time, we have to transition and lift the market. And so for that reason, okay, we're at Harvard. So Harvard is like A+. Everyone's A+ student.
It's like great inflation.
That's not inflation. We try to put it, for our large classes, we try to have it grades. Yeah.
There are some A's.
I was rejected, I will say, publicly, at Harvard years ago. Anyways, so if we look at our ratings, so we rate from A+ to E. There are less than 5%, we've rated about half of the volume of the market. Less than 5% is in our A range. Less than 3% is in that A+ range. Within the B range, we're less than 10%. So we really see that the market really does need to improve it if it's going to get past this crisis of confidence and build into something that can scale and be sustained. And so because of that, I think somebody has to think about the standards today and how they're going to evolve. My sense is what we see and what you'll see in this report is like the inklings that we are moving towards a better, higher quality market. But I do agree with you. Like, one needs to, if they're going to make an investment, not just think about where the market is today, but how it must, evolve to higher quality over time, as well as shift, as the Oxford principle suggests, to sort of from avoidance to removals over time as well.
Yeah, so just really quick, great question. So First, three points. One is with respect to the Integrity Council and how we think. I mean, there's no number we're looking for. Not even we. It's like the expert. It's just assessment. Methodology by methodology. But I will say, but I think what Donna just suggested about their ratings probably is a guide to where I think the kind of shares that ICBCM is going to end up with approving. But there's an important point that you want to look at the future share, not the current share, right? So the question is, how big can the future market be if we get the integrity right? And so I don't mind if ICBCM knocks out, if it's consistent with maybe, I don't know, B plus and not, right? So if it knocks out 80% of the market today, but then that market grows by an order of magnitude because of that, that's a great outcome. We have to figure out the overhang, but that's a great outcome. So that's point number one. Point number two is, by the way, we're already seeing that. In fact, there were a number of standards. So program standards, carbon crediting standards, were asked to submit their methodologies to the ICBCM, and a number of them actually withheld standards because they knew that they weren't going to make it, right? And so that's a good sign because they're retooling and they're going to submit the high ones. Number two is continuous improvement. That's something that ICBCM is very open about. So this is the version now. We're going to go through, assess the market, and that'll be good for current projects under that. But in the future, we're going to have another round, and then once that's in place, that will be going forward. Looking ahead, that'll be sort of the next wave. Finally, I want to double click. The time profile point is so important. I'm so glad to hear you say it, Nelly. I mean, I'm not surprised, but there was this sort of fight a little bit like, removals or reductions, which is better? And I think we need to think about the time profile. Today, there are really urgent issues we need to address, like saving tropical forests. I happen to believe, I've worked on this, that we can use carbon markets to do that. That's a reduction, avoidance, whatever you want to call it. But if we don't save tropical forests, we're just game over for the climate. So that's what we should do right now, or that's one of the priorities. But if we look ahead, we should be developing the kind of technologies we need for removals going forward.
Carolyn, please.
Yeah, so first I need to give a shout out because we were in the same class at Harvard. Not everyone is 87.
Rumble outside.
Classmates.
I'm feeling a little left out.
Sorry about that. I just wanted to give a shout out. But actually, I think your point is completely, like I see this world the same way. I think there are three major vectors. One is removal versus this reduction point. And I believe that from the quality perspective, if you can actually start thinking much more about reduction, much more about removal, less about reduction, from wow, I really saw that amount coming out of the air. It's just sort of like, oh, okay, that makes sense. Not to say we want to save the forest. I'm not saying don't want to do that, but if you're trying to create a market where everyone actually has trust and believes in it, it's much easier to explain that more broadly than this theoretical, this could have happened, therefore. So avoidance or reduction is just a harder story from a market perspective. Secondly, I think nature versus engineer is another element of that. Engineer is just, again, easier to explain. So if you say an engineered removal, that to me is super easy to explain. Obviously, there's not much of it out there, which is very expensive. At the same time, that will bring trust to a market, and it's very easy to explain, and the standards are actually fairly simple. You can count molecules, you can sort of get that, if you will. And then the quality vector goes sort of on top of that in some levels as well. So to me, it's there's going to be an evolution of each of those three, but it will go back and forth. But I believe that if you're going to actually get this market to scale, you need more removal, you need more engineered, and you need higher quality.
So I will admit that your moderator has been captivated by this panel. There's been a poor job calling on you to ask questions. We have many more hands than we have minutes left in this session. I'm going to go here in the middle, and then apologies to everyone else. This will be our last question.
So, Wanda Reiner from Clean Energy Venture Group. I was really intrigued by Carolyn talking about the accounting, because I think that's really a missing piece. I've looked at various methodologies and gotten a fundamental sustainability accounting. But and we talked a little bit about the time, and what I really don't see anywhere is sort of a discounting time value of carbon credits or sustainability efforts, because we have to solve the problem now. It doesn't matter if it's going to be 1,000 years out. And why should we get credit for something that's really not going to solve what our urgent issues are right now? When everyone says we've got to solve it within 5 to 10 years, or we're going to reach a tipping point. So I was wondering if you've seen anything like that. There's so many standards out there. If you've seen anyone starting to look that way.
David.
Just two things quickly. One is, the market is doing that, maybe not the language you heard up here, but the market in effect is doing that with price and these various assessments of quality. We're in this period of chaos right now because it's not clear what works, what doesn't work, and that chaos is intrinsic to real people trying to solve the problem. I want to say one more thing about the time horizon that implied by your question. I am very worried that there are some bright line standards or ideas now emerging around permanence, and in particular, a strong bias in the direction of credits that are, you can measure every molecule, and you know it's down there because you sequester it geologically. Well, that's great for very, very expensive projects, but if you start working on the politics of this problem as well, we need to be doing projects that engage in rural communities, for example, which means soils. There's a whole class of projects, soils, mostly ocean projects, where you can't measure every molecule. But there are ways to create price incentives for quality and strong monitoring, reporting, and verification. And there could be a very large climate value to less permanent projects. But if buyers are only going to be buying things that are permanent, then all of that stuff's going to get shut out of the market. And there's a risk of treating the instinct of the behind the question about discounting as a bright line standard for permanence.
Any last quick comments from the rest of the panelists?
Maybe just one thing. I think we need to reimagine the VCM. I think the VCM today, we have limited finance to tackle climate change. If we're going to have money going into something like the voluntary carbon market, I almost wish that there was an attribute, and that attribute, actually this is not my idea, I stole it from Bill Gates, so I have to admit that. But he talks about paying down the green premium. Like, we should be focusing that finance on things that are going to transform our economy. And I don't know that right now credits have that attribute like built into them, and companies are thinking in that way. They're just thinking, how do I get to net zero? Rather than, how can I put my money in the best possible way, that it can be to tackle this climate crisis. And maybe that's what I'd like to see the market doing.
Yeah, I think just to the point on the counting of molecules, I think what's really important is over time is for there to be a lot of confidence. I think Ellie's question of like, gosh, I have clients who love to buy farther out. At the moment, everyone buys like 1 year at a time. And you have a few sophisticated companies who are buying further out, but they have all these complex questions related to it. Are the standards going to change? Is it going to be permanent or not permanent? What have I bought? And am I going to actually buy something 5 years later? I'm going to have terrible press because something bad happened, and it's like, gosh, I was trying to avoid it. So that tenor and that timeline is a complex one. But the more we can actually create term structure in this, the better it is. And the only way in some level to do that is to do that in small scale and to do that in where there's high confidence. And generally what happens is people who do things with high confidence, then there'll be concentric circles around. Because they'll say, oh, okay, I get how this works. There's a pricing mechanism, there's term structure, there's standards, and it's been consistent. Then as a result, I feel comfortable with a discount to that. We've got the treasury market, which in theory is the gold standard for risk-free rate, and everything from that goes beyond that. Similarly, we may evolve in that respect. It doesn't mean that not everything will be AAA rated, but there'll be a price differential from that, and that's very important for developing markets, creating scale, and having structure.
Nat, 30 seconds.
Yeah, I would just say I hope people come away from this thinking, okay, here's a tool. It's not a silver bullet. It's not the only tool, and it's definitely second best relative to policy. But it is a tool that's out there, and if we can get some of these issues around integrity and accounting and data and transparency right, it could be a meaningful contribution to channeling finance into green growth and to emission reduction. But only if we get the integrity right. That's what we need to do.
So in closing, let me know, I know you have a lot more questions. I have a lot more questions. My colleagues here at Harvard on this issue are also asking a lot of questions about the voluntary carbon market and voluntary corporate emission reduction goals in a project supported by the Salata Institute. If it's something you're interested in, let me know, follow up with me. You may follow up with your questions quickly here on the margins before we go to, I think, drinks, hopefully?
Yeah.
And with that, please join me in thanking Carolyn, Nat, Donna,